Today's webinar is called Creating Your Paycheck in Retirement, and this is just a part of the work we do with our clients to help them feel truly cared for and to live lives of meaning and generosity. We've pre-recorded the presentation portion of the webinar, but before we go there, I just have a few housekeeping items. The first is that we're going to try and keep this to 30 minutes.
That's right.
It's also being recorded, and so you will receive an email with a link to that to the recording of this somewhere between 3 and 5 days after. At the bottom of the page, you'll see a Q&A button on your screen. So if you've got a question at any time during the presentation, go ahead and hit that button, type in your question, and Joe and I will join you afterwards to hopefully answer it. There's a chance we're not going to get to all of the questions that have been sent in. So if we don't get to yours, we will make sure to email you personally in response. With that, we'll head to the presentation portion, and then Joe and I will join you afterwards for a live Q&A. Thanks. So Joe, you've worked with a number of people heading into retirement. You mentioned that transition can be pretty difficult emotionally.
Yes, Jason, I think that's an understatement. A lot of the clients that I work with as we help them walk through the retirement transition really struggle with this idea of taking money out of their investments. I think it's because we spend so much of our working years, we're accumulating and we're saving money from our paycheck into our 401k. We maybe invest some other monies, and we're watching this grow. But now we have to start seeing that maybe reduce because we're taking money out.
Yeah, and when we were preparing for this, you mentioned, even though I've done this with lots of people and had the conversation, I suspect it's going to be difficult for me once we start to take money out of our accounts.
Yeah, guilty as charged. It's one thing as I sit across the desk and talk to people about their money, but it's when I'm on the other side of the desk talking to my financial advisor and he's telling me that same thing, I kind of get this pit in my stomach because my dad told me you never take money out of savings.
Yes.
It's only for going in.
Well, something that's been helpful as people make that transition is just thinking about money coming out as a paycheck, because that's what we're so accustomed. Yeah. Money goes in as a paycheck, it comes out as a paycheck.
Yeah, it's a really good way to think about it. And sometimes I describe this idea of your cash flow centered around this paycheck. And you can think about your salary as kind of, you turn the spigot on and that money is flowing into your checking account, and you want to maintain a balance within that checking account because your living expenses just kind of are pulling that money out. And ideally, you've got more income, right?
Yeah.
than the expenses that are going out. And in retirement, you really need that same situation.
So we want to talk about the money that could go into your checking account to manage all of your expenses in retirement.
Exactly. Now, something key with that is you got to know what those expenses are.
Yeah.
And so as people prepare for retirement, one of the key numbers that they need to kind of figure out is what does their lifestyle cost on a monthly or an annual basis.
So talk with us then a little bit about those sources of income in retirement.
Well, if we just take this same picture and modify it just a little bit by looking at 3 different categories. We've got guaranteed income, and then we've got investments, which will separate into qualified and non-qualified investments.
Okay, so guaranteed income, we have maybe a little bit of a sense of that, but talk to us about what that is.
Sure thing. Well, guaranteed income, or it could also be called contractual income, because this is income that you have essentially contracted with another party to provide you with for probably the rest of your life. Social Security would be the best example of that. And IPERS would be an example for a lot of our Iowa listeners. We've got other pensions, perhaps annuities, perhaps there's rental property that's paying you an income. Those are all types of guaranteed income. And for the most part, that's taxed to you as ordinary income when you're in retirement.
Okay, so we've got those potential sources of guaranteed income, but what you and I want to focus on today are those 2 other sources of income,
right.
These qualified and non-qualified buckets. So talk with us again and maybe just remind us of how does how is the tax how does tax work when you're putting money into those buckets?
Well, let me just first say the tax code is complicated.
Yes.
So when we talk about how taxes work, um, it's probably a good spot for our first disclaimer
Yes.
of the webinar, and that's that you probably will want to talk to a tax preparer, your CPA, about the nuances of some of these things that we're talking about.
And of course, we know it could change
It
in the
could
future. So we're going to,
it's a high likelihood that it'll
yes.
change at some
But
point
for today,
for
at a high
today, right?
general level, how does it work when money goes into these accounts?
Well, most of us are familiar with the idea of a retirement account that's set up through your employer.
Mhm.
Okay, a 401k, a 403b, those kinds of accounts. And what happens with that is you take the money before you pay taxes on it and you set it aside into what is called a qualified account. It's qualified for tax deferred savings. So it
Mhm.
can grow tax free. You get a tax advantage by putting the money in pre tax.
Mhm.
So you're not taxed on that. It saves you money when that goes in.
And in general, you'd want to fill up that bucket as big as it could be.
Yeah, for the most part, people will pay a higher tax rate during their earning years than they will during retirement years. Not always the case, but as a general
Mhm.
principle, as I've worked with hundreds of retirees, that's often the case that it's you're paying a higher rate or during earning than you do during retirement.
Okay, so these non-qualified dollars, then how does tax work as you put money into that, and why create that bucket?
Oh, flexibility is the key word.
Yeah.
So how does taxes work there? Well, once that money flows into your checking account, usually your income exceeds your expenses. That can create this buffer, this margin. That margin gets big enough, you want to do something with those dollars. So if you invest those dollars into an after-tax investment account, that's what we're referencing as a non-qualified.
Okay.
Why is that? Well, there's really no benefit tax-wise for putting the money into that account, but it creates a lot of flexibility during retirement when it comes time to create your paycheck.
So, Joe, you've talked about how taxes work when you put money into these retirement accounts.
Mhm.
How do they work when we pull money out of them during retirement?
Well, it depends on which account. If it's coming from the qualified account, it's going to be just like your paycheck because this is ordinary income and it's ordinary income tax rates. If it's coming from the after-tax account, the non-qualified, well, it's going to be capital gains rates. So let me talk about that just a little bit more. Ordinary income tax rates are different than capital gains rates. And so when we talk about the tax code, it's important to understand what kind of income we're actually referring to.
Mhm.
So with qualified accounts, everything that comes out is going to be taxed as ordinary income. With a after-tax account, it's going to be different from that.
What's the difference?
The difference is something called capital gains. Let's say you buy an investment for $1,000. A couple of years later, you sell that investment for $1,200. That gain in the investment, that $200, is going to be taxed as capital gains. And that rate, historically, has been substantially lower than ordinary income.
Okay, so the qualified dollars come out and every dollar is taxed at the ordinary income rate. The non-qualified dollars come out and it's only the gain that is typically taxed at a lower rate.
That's correct. When
Okay.
the sale is made, you pay the capital gains.
Okay.
That's exactly right. The second part that you should understand about taxes, did I mention that they're kind of a complex topic?
You did.
Okay. Well, the tax code is thick, but we're going to do it all in one PowerPoint slide. But the part I want to emphasize here is this idea of the tax brackets. And I think about those as being just simply three tiers. The first tier, you're going to pay up to 12% on ordinary income tax there, okay, up to around $80,000. The second tier you pay 22 or maybe 24%. That goes clear up to about $330,000 of taxable income. There's a third tier, and that's for everything higher than that. But for our retirement distribution strategies, we're not really going to spend a lot of time there because that doesn't affect most of us.
So those non-qualified dollars, how are they taxed in those first two tiers?
That's where it gets really good. Okay. The capital gains rate when you're in tier 1 is 0%.
Very nice.
Yes.
That's unusual.
It's very unusual. The capital gains rate when you're in the second tier is 15%.
Okay.
And so that's why one of the things you really want to look at is whether or not you can stay in that tier 1 because of the flexibility that gives you in terms of managing your taxes.
Great.
Now, not all of your income is taxed. There's the standard deduction, which is $25,000 to $28,000 there. And essentially what you can do is take your income, subtract $28,000, and that's going to be your taxable income.
Okay.
Okay. Now, it's not that simple. There's other factors.
Yes.
Okay. So you may want to talk to a tax professional when you're actually making your plan, or talk to your financial advisor and they can kind of help work this out for you.
So work this out for us where you've got kind of these three major considerations, these sources of income, retirement buckets, your expenses in retirement, you've got taxes. Put those together in a kind of a real world situation for us.
Yeah. Let's consider this client, Rebecca and Miguel. They need about $120,000 to live off of this year. And they have about $30,000 in Social Security income. That means that they need to take about $90,000 from their investments in order to meet their living expenses. So the magical question, how much do they take? How do they get that done in hopefully a tax efficient manner?
Mm-hmm.
Well, Miguel and Rebecca are both fairly attached to their non-qualified account. They worked hard to build that up over time. And so that $1 million is kind of viewed as non-touchable to them. They have their retirement account that they think about is the other $1 million. And so their first thought process is, hey, let's take everything out of the IRA, out of that qualified account, and that can produce our $90,000 that we need. Added to the 30, that gives them the 120 to meet their annual expenses. They talk to their tax preparer, they talk to their financial advisor, and they do some calculations, and they're going to have to take about $105,000 from their IRA in order to get $90,000 into their checking account.
Mm-hmm.
So in other words, it's going to cost them about $15,000 in taxes. So they're wondering if maybe there's a better way to do that. So they have the conversation with their financial advisor, and the financial advisor is able to help them think through this non-qualified money and suggests a different approach. Maybe taking $55,000 from the non-qualified, which means they only need to net $35,000
Mm-hmm.
from the qualified account. Well, when they do that calculation, that's only going to require $39,000 from their IRA. Put all that together, and that's going to save them roughly $11,000 in taxes by doing that.
So that's where the flexibility of having these multiple accounts comes in.
That's exactly right.
And that's $11,000 you could do something else with in retirement, or maybe just leave in your account to continue growing.
Exactly. And that's where a lot of times as we're having conversations about these things, people will ask, well, what about long-term care? What about this? What if I want to do a big gift? What if all of those things? Well, saving this $11,000 may help meet some of those other goals later on as well.
Okay, so then halfway through the year, their car breaks down. You've already set the plan for how this is going to be distributed through the year. And they don't want a car loan. They just want to get a new car.
Right. That's where, again, having these different buckets really gives you a lot of flexibility. In that example, the non-qualified dollars are there. It's a great place to pull that money from because any capital gains there, remember the rate on that, Jason?
It's zero in tier one.
It's zero. So that means if you need $30,000, you can get $30,000 out. But if you're going to take it from your qualified account, you're probably going to need $35,000 in order to get $30,000 after tax.
And I guess, Joe, you're big on charitable giving. I know this too, and we haven't talked about it, but having those two accounts also gives you a fair amount of flexibility in retirement in terms of giving as well.
Absolutely. And that creates a whole lot of other conversations about where's the best place to pull those
Mhm.
dollars at different stages of life.
All right, so wrap this up for us. Just some big key points to remember.
Absolutely. I think when it comes to your retirement distribution strategies, first of all, you got to know what you spend. That's going to be the outflow from your checking account on a monthly or an annual basis. Understand kind of the key basics of the tax code, which I would say are the tiers and the types of income, ordinary income and capital gains, and how those are taxed differently. And then thirdly, I'd try to stay in tier one if at all possible because of the benefits of that long-term capital gains rate.
All right. Well, thank you so much, Joe, and thank you. We look forward to the live Q&A after this. Welcome back, Joe. I thought you did a great job.
Hey, thanks, Jason.
So we had one quick question to get to. Somebody wondered, what is MFJ?
MFJ is married filing jointly. It's one of the tax statuses. There's married filing single or just as a single as well.
Okay, thanks for clearing that
Yeah.
up. So first question is, related to in retirement. What should your allocation be in terms of stocks and bonds at various ages?
Well, if I could answer that for everybody in one sentence, I think I'd probably be out of a job.
Yeah.
So the way that we think about allocation actually is kind of like a three-legged stool. There's three components to it, and it's way more than just simply age. The first one I sometimes refer to as the sleep factor. Basically, as an investor, you want to be able to sleep well at night, so you don't want to be invested any more aggressive than what you're comfortable with. So that's a very important one there. But the other two are more numerical. There is the lifeboat. The lifeboat is this concept of having enough in the preservation part or the bond part of your portfolio that you can handle 8 to 10 years of distributions from there if you need to. So obviously key with that is knowing those expenses that we talked about in the video there as well. And the third one really incorporates all of your assets together and your overall plan, because that's really how hard your dollars are needing to work in order to make your plan work so that you can sleep well at night.
Yeah, and I imagine that for many people, how hard they need or want those dollars to work, again, is going to just vary from person to person.
Oh, yeah, it absolutely will. In fact, we had a client. He was in his 80s or upper 80s, and he had enough money that he knew that he would never spend all of it. So his allocation was all stocks. Everything was on the growth side of the portfolio because he figured, hey, if the market drops and I lose half of it, I'm still fine. So I may as well have it all invested because that way it has a higher probability of growing.
So no necessarily like overall rule of thumb. You'll probably hear a constant refrain from us throughout this Q&A that, yes, maybe some general ideas, but everyone's situation is unique. Everyone's goals are unique.
Right.
Everyone's hopes are unique. Everyone's financial asset level is unique.
Absolutely. That's really where a good financial advisor is going to be able to help you understand what you have, where you want to go, and kind of putting those together to create that paycheck in retirement.
So we had a number of questions come in about Roth IRAs and, like, when should I do conversions? When should I do contributions? How should I use it and think about it? Remind us again, just briefly, what is a Roth IRA?
A Roth IRA simply is almost the opposite of a traditional IRA. In a Roth IRA, you don't really get any tax benefit when you put the money in to a Roth IRA, but everything from that point forward grows tax-free. So that makes it really nice from a tax planning standpoint. You know what the taxes are that you paid, and then when you pull it out, it's tax-free. Just as a contrast with a traditional IRA or what we call the qualified accounts, so the 401k, those kinds of assets, you actually receive a tax benefit that we mentioned when the money goes in. Okay. But when you take it out, everything is taxable.
Yes.
So in our model, a Roth is sort of a hybrid between
Yes.
the two, and it can serve a really nice place in your financial plan.
So if I'm moving into retirement or I'm in retirement, what are some maybe general good uses or how to think about using a Roth?
Yeah, so in terms of our model, a Roth would fall into the non-qualified side because it's not taxable. So you can think about those dollars. Practically speaking, they're great dollars to use for buying a car. You know, if you're taking the family on vacation, you all want to go to Disney World and it's going to be a $20,000 trip, you just take it out of the Roth IRA because you don't have to pay any taxes on that. Those are a couple of just, kind of big one-time expenses, make it a great tool for that as one example.
Well, and I think you were when we were chatting about this as the pre-recorded portion was going on, just some uses too, and thinking about like if you're in tier 1, tier 2, tier 3.
Yeah, that's I think the tier idea is a great way to think generally. So if you're in tier 1 and you're thinking about doing some Roth conversions, so that's moving money from a traditional IRA to a Roth IRA. If you're in tier 1, I'd say it's probably worth looking at and worth considering, because ultimately the math behind it all is the taxes they're paying at that time of conversion compared to the taxes you're going to pay in the future. That's really the fulcrum really of the decision making. So if you're in tier 1, it's probably worth considering. If you're in tier 2, it might be worth considering. And that's going to be very personal in terms of your preferences on your taxes. It may or may not actually make, in the big picture, a difference financially, but there may be a preference piece on there. There may be some estate planning ideas and some of those others, which we really don't have time to do. And tier 3 is easy. You probably don't want to do it because when you're in tier 3, you're at the highest tax brackets that there are. So you want to do everything you can to get out of that tier 3 in terms of reducing your tax liability, not increasing it through those kinds of actions.
Thanks. So another question came in about, you addressed this a little bit, is the capital gains taxes, but bottom line, how do I limit my long-term capital gains?
Yeah, I think, I sometimes remind clients that long-term capital gains do incur some taxes, but it's not really a bad thing because that means your investments did exactly what they were supposed to do, which is grow over time. So we'll kind of start with that. But that being said, we want to keep our money, right?
Maybe be thankful.
A
portion, maybe be thankful.
Right. So around Thanksgiving, it's a good time to be talking about capital gains, right? No, but with capital gains, there's a couple of strategies that can be used. One is one involving the management of your portfolio. You can use something called tax loss harvesting. So if there's a market downturn, you can sell lower, maybe when that's at a loss, and use those losses in the future to offset some of those capital gains. A second one we referenced already, which is if you're in tier 1, you really don't need to worry about those capital gains because they're going to be taxed at a 0% rate. Now, disclaimer part, there is some effect on Social Security income and some of those other pieces that come into play. That's where the tax professional and those conversations come in there. But the third one is one we really like. Okay. We talk about helping our clients live lives of meaning and generosity. So when we have clients that have large, what's called unrealized capital gains. So that means you've got something that if you were to sell it, you would realize those gains. So these are unrealized at this point. If we take that and if we take that and donate it into like a donor advised fund, or maybe donate directly to a charity, you actually get the charitable contribution for the whole thing without ever having to pay those taxes. It's a great tax planning tool, especially if it aligns with charitable giving that you are going to be doing in the next year, 2 years, 5 years or so. In that donor advised fund, it can kind of sit there and you can still do what you're planning on doing, but you have some additional tax benefit.
Yeah, so, another sort of argument for having multiple buckets in retirement to create flexibility for not only your distribution needs, but even your giving desires as well.
Absolutely, absolutely.
So we had one brief question on annuities as
Mhm,
well.
right.
Joe, and just wondering about the use of a fixed index annuity.
Right. So a fixed index annuity would be on our graph that we had earlier. We have the guaranteed income. And so that would produce that guaranteed income. But what an annuity really is you're giving your money to an insurance company and asking them to give it back to you in certain installments. And so it takes a while until you actually kind of get some benefit on there because it's just kind of your money that's coming. But the annuity company will calculate how much they can give you for that guaranteed time period because it's a contract. So that's what an annuity is. In our model, that turns the spigot on and it's taking assets from the qualified or maybe the non-qualified side
right.
and putting them over on the other side of the picture as guaranteed income. So it's transferring that over there. One of the things we're not big fans about is that it limits your flexibility there.
Yeah.
So if tax law changes, if things change, well, you've already signed that contract, so that part can't change. So you're kind of limited on some of the things that you can do.
Another one of those things, Joe, too, when it comes to annuities, everything we've talked about, who you are, what your situation
Absolutely.
is, what you need, what
Yep.
you want. I suppose we are trying to make a case for why our jobs matter.
Well, I think it does. And, we talk a lot about just peace of mind.
Yeah.
The clients have peace of mind having someone to talk to. And obviously, we'd like that someone to be foster group. But if you already have a relationship, go to your financial advisor, have these conversations. And if you're looking for a second opinion, we're always around too.
Yeah. So as we wrap up today, just a few things to share. First of all, the entire webinar has been recorded. You'll get an email with a link sometime in the next few days. Secondly, I want to thank all of you who joined us. I want to give a special thanks to our clients who joined us and just say thank you for the privilege of being able to serve and work with you. And then for those of you who aren't clients, Joe and I would like to extend an invitation to you on behalf of Foster Group to say, even if you never become a client, but you've got a question, you need some help, you'd like to go to a trusted source to say, hey, what should I do with this? We would love to help you out no matter what. So there's contact information on the screen if you'd like to get a hold of us for any of your questions. And then finally, you're going to be sent a link to the survey after the webinar. We would appreciate it if you took the time to fill that survey out. Your feedback helps us get better. With that, we just want to say thank you for joining us and we hope you have a great day. Bye.
Bye-bye.